I'm going to do a presentation for you to show you how cost segregation actually runs through your tax return to save you money at tax time. If you're the kind of investor that likes to know how the numbers work, this is going to make a lot of sense to you. If you don't look at your tax return, you don't need this presentation at all. If you're a CPA that has not used cost segregation as a strategy for your clients, this is going to resonate with you as well. Okay, so we're going to start with a story. We're going to tell a story about a couple in 2018. Joe, the husband, he's an engineer, we'll say, and he made $80,000 on his W-2 last year. His wife, Mary, she's a realtor, and last year she made $100,000 in her business. That's after expenses. Good job, Mary. Right? Also, in November of 2016, Joe and Mary bought a fourplex. Right? And each unit, they make $2,000 a month in rent on this fourplex. Okay? So this is their story. Back in 2016, they paid $900,000 for the property, which they determined $100,000 of that is the value of the land, right? The dirt underneath. What's left over, the $800,000, is called improvements to the land. Okay, so this is how their tax year kind of falls out. Okay, now it's tax time. They got to go to their CPA. We're going to say their CPA, Jill, right? Jill's going to do their tax form. It's Form 1040, right? That's the main tax form for a personal tax return. The very first line on Form 1040 is wages. For these guys, we're talking about wages. We're talking about Joe's wages, the $80,000. Okay, that's an 8. Okay, and I'm going to draw a green line here so we can keep track of all these numbers. Next on the Form 1040 is called Other Income. Other income is calculated on a separate form called Schedule 1, Other Income. Okay, now there's a lot going on in Schedule 1. Okay, I'm not going to go through all of it. I'm going to go through the stuff that's important to these guys in this story. First off is called Schedule C. That's business income or loss. For these guys, that's Mary. Mary made $100,000. Right? And I'm going to draw that line so we know where these numbers are coming from. Next, I want to talk real quick about Schedule D. That is capital gains. So in our story, Joe and Mary in their spare time in 2018 did 2 fix and flip projects. They bought real estate cheap, they fixed it up, they sold it. We're going to say they made a profit of $20,000 on each project. Okay, so that $40,000 in profit rolls up under Schedule D, which is part of the whole Schedule C calculation. Next, we're going to talk about Schedule E. Schedule E is real estate rental income. Now, if you're an investor and you own real estate that you're renting out, this is where you calculate or address the income that you made in your rental properties. So we're going to break that down. Schedule E. The first line on Schedule E says, what were your gross rents last year? For these guys, if I switch my colors, right? $200,000 a month, 4 units, $8,000 a month, 12 months, right? So that is $96,000. Okay, that's rents. Now, Joe and Mary don't pay tax on the rental income because they have expenses to run this property, right? So if I list some expenses are going to be things like maintenance, insurance, management fee, mortgage interest, taxes, and depreciation. Okay, so I'm going to plug some numbers in here for this story. We're going to say their maintenance, they spent maybe $5,000 last year maintaining the property. Insurance, we'll give that a $3,000 number. Management, maybe $8,000. Mortgage interest, that's the big one, maybe $25,000 in mortgage interest expense. Okay, and then taxes, we'll call that another $5,000. Then we get to depreciation. Depreciation is an expense against income. How it's calculated, we actually have to come back here. We have to look at the improvements. The improvements, this $800,000, the law says that in exactly 27 and a half years, this building's not going to be worth anything. So we take $800,000, I'm going to do this in blue for the depreciation, 27.5 years, gives us a depreciation deduction of $29,090. Okay? So that means every year for 27 and a half years, they get an extra $29,000. So I'm going to throw that over here. Okay? There's a $29,000, I'm just going to round to make it easy, depreciation deduction. If we add all this up, total expenses, right? 5 plus 3 plus 8 plus 25 plus 5 plus 29 should be $75,000. So they brought in $96,000 in income, but they spent $75,000 to do it. What's left over is called tentative income. Tentative income. 96 minus 75 for these guys, $21,000. Now we do have to address an issue called loss limits. We'll come back to this at the end. But for Mary, if she's a realtor, there's a good chance Jill, the CPA, is going to designate her as what's called a real estate professional, which means she has no loss limits. And that'll make sense when we get further into it. What's left over, we end up doing this, and this is called total income. Total income for Joe and Mary in this case, $21,000. That's total income on the Schedule E, which then I'm going to do my green line here. This comes in here, right? Schedule E rolls up under Schedule 1, and these guys have a $21,000 Schedule E income. All right, now I do have to address, just for conversation, Mary owns her own business, so she's got to pay an extra tax called self-employment tax. On Schedule 1, we get half of that tax back, so we're going to call that the self-employment tax deduction. So I'm going to say for the $100,000 that she made, her self-employment tax is going to be somewhere around $3,000. So we're going to get a $1,500 drop on this schedule. So if I add all that up, we end up with what's called total other income. Okay, 100,000 plus 40 plus 21 minus 1,500, that comes to $159,500. Total other income. Total other income, draw the line here. It's going to go in there. And again, now we're back on Form 1040. Total other income, $159,500. And if I add those together, that's called total income. Okay, for these guys, $239,500 in total income. Now, again, Joe and Mary don't pay tax on $239,000 because, like everywhere else we see, there is a deduction against this before tax is calculated. On Schedule 1040, the deduction, you can do it one of two ways. Schedule A is itemized deductions, or we can take what's called the standard deduction. For 2018, for a married couple filing jointly, the standard deduction is $24,000. So we drop their total income by $24,000, and that gets us what's called taxable income, right? TI, taxable income. For these guys, $239,500 minus 24 is $215,500. This is what Joe and Mary pay tax on. Now, how do they pay tax? Well, it's a little complicated, so let me do that over here. Joe and Mary are going to pay two taxes. Okay, the first one is income tax. Everyone pays income tax. In the U.S., income tax is calculated under a bracketed system. The first bracket, the first 0 to 19,050 earned, taxable income again, right here, TI, that's taxed at 10%. The next bracket, 19,050 to 77,400, that's taxed at 12%. The next bracket, 77,400 to 165,000, is taxed at 22%. The last bracket for these guys, 165,000 to actually 315 is the bracket with these guys. I draw the line here. They cap out at 215.5. Where am I at here? 215.5. That's a 5. Okay, that's taxed at 24%. If I add all those up, we get total income tax. Okay, let's do some math. 10% of $19,050 is $1,905. Okay, now we take this bracket, 77.4 minus 1905. At 12%, that's going to be $7,002. The next one, 165 minus 77.4 at 22%, that's going to end up being $19,272. And then the last bracket, 24% of the difference here is going to be $12,120. We add all this up, their total income tax is $40,299. Okay? That's income tax. Now remember, Mary owns her own business, so she has to pay self-employment tax. I'm going to put SE tax here. And we said earlier, that's going to be $3,000. Right? We got half of that, remember, back here in the deduction on Schedule 1. Okay, we add this up, right? Their total tax is going to be $43,299. If I take $43,299 divided by the $180,000 that they brought in, a nice number to look at is called the effective tax rate. They're going to pay about 24% of their income. Okay, not bad. Now I want to relook at depreciation. Remember, depreciation we have over here. If I break that down a little bit, remember they have an $800,000 asset depreciating, right? They bought it in 2016. They had depreciation in 2017 and now 2018. And if you remember, we said $29,000 a year for 27 and a half years. So 2018, we're going to say that's $29,000. Another $29,000 back in 17. In 16, we have to address a thing called Depreciation Convention. For this type of property, convention's called mid-month, which means we get half of the month in the month that we bought the building. Doesn't matter what day of the month. And we get the remaining months. In this case, we only have December. So in 2016, they get 1.5 months of depreciation. So if I take my $29,090, divide it by 12, and then multiply by 1.5, we get a number around $3,600. I'm going to call that $4,000. Okay, this is called straight line depreciation. If we add all that up, that's going to be $62,000. This is called their accumulated depreciation at the end of 2018 that will eventually add up to $800,000 when we get to the end of the 27 and a half years. Now I want to talk about my favorite tax strategy, cost segregation. I even like it more than R&D, Beth. Just saying. Okay, cost seg, the whole strategy around cost seg is an IRS-approved method of taking this $800,000 asset, breaking it up into a bunch of little pieces. Okay, once we break it up, we have to look at each piece and determine under the law what pieces can we reclassify as personal property. Now this project we actually did in 2018 for a 2018 tax return down in Florida. Okay, and the actual results, we took that $800,000, we broke it up, and we put it into different buckets. Okay? So, this actual project that we did, we ended up identifying, out of that $800,000, we identified $230,000 of that $800,000 that should be depreciated over 5 years instead of 27 and a half. Another $80,000 we determined was 15-year property. And the remaining $490,000 stays with the building, 27 and a half year. Okay, so if Joe and Mary, back in 2016 when they bought the property, decided to do cost seg back then, their depreciation would look different. We're going to call that segregated. Segregated depreciation schedule. In 2016, instead of $4,000 in depreciation, they would have gotten $15,000. In 2017, the second year, which is always the biggest year, they would have gotten $113,000 in depreciation. And then the third year, here in 18, another $77,000. If I add all that up, their accumulated depreciation would be $205,000 compared to the 62. Okay? The law, it's actually Internal Revenue Code, IRC, section 481A, discusses a concept called catch-up depreciation. If Joe and Mary chose to do a cost seg project before Jill filed their 2018 tax return, this law allows them to catch up on the depreciation they missed. That amount of depreciation, $143,000. Additional depreciation. All right, so now that I got it all laid out, let me show you what this does. We take this $143,000, we're going to bring it over here, and we're going to plug it in right there. So now we have an additional, on the 2018 return, we have an additional $143,000 in depreciation expense against income. If we add the 143 to the 75, we end up with $218,000 in depreciation now, or in total expenses. If I take that 218, I subtract that from the 96,000, Joe and Mary lost $122,000. Now, did they actually lose $100,000? No, they made $21,000. This is a paper loss, right? This is all done to calculate their tax liability. So watch what happens. We take this $122,000. Again, we'll address loss limits in a minute, right? She has no loss limits as a realtor, so we're going to say their total income on Schedule E is $122,000. Okay? We run that through, bring the line over here. This $21,000 changes to negative $122,000. You add all this up, this total other income drops from $159,500 to $16,500. Run it through, draw the line up here, this $159,500. Now back on schedule form 1040, $16,500 plus the $80,000 is $96,500. Right? We still have a standard deduction of $24,000. So now their taxable income drops from $215,500 to $72,500. Okay. Running it through the calculation here, this actually gets plugged in up here and caps out. This 77.4 caps out at 72.5. So now this 72.5 caps out this bracket at 12%. 72.5 minus 19,050 is $6,414. Okay, what's awesome is we don't pay any tax at that bracket, no tax at that bracket. So we add the 6414 plus the 1905. Now our total income tax dropped to 8319. We still have a self-employment tax of $3,000, so our total tax is now $11,319 with an effective tax rate of 6%. Okay? What this means is by doing cost seg, they can reduce their tax bill from $43,299 to $11,319. The difference, a beautiful number, $31,980. Okay? Now what I find fascinating, if you're a great investor, you work really hard at negotiating the purchase price. Right? You do everything you can to increase or maximize rents while decreasing and reducing your expenses to get every earned dollar out of this property that you can. Right? And if you're good at this, you might get $1,000 here or there compared to your competitor, but you overpaid $32,000 in taxes. Right? So in Joe and Mary's case, if Joe is pulling a W-2 and he's got deductions against his income, right, the withholding, he has overpaid, he's paid in his taxes. Mary's probably paying quarterly estimated tax payments. So when Jill does their tax return with a cost seg study built in, these guys are going to get $32,000 back as a refund. Now what would you do with $32,000? Cash, right? We can reinvest it in this property and make improvements. We can use it to maybe a down payment for your next property. Heck, Joe and Mary can actually go on a cruise. It's their money, right? So the whole idea here is we want to leverage the law, right, to address or minimize our tax liability legally.